Attempting to trade without a solid grip on technical indicators is like trying to shoot a landscape with the wrong camera lens. The data is all there, but until you attach the right lens, the picture stays completely unreadable. In trading, that lack of clarity has a direct financial cost. You misread the depth of a dip, enter a position too early, and end up holding the bag. Or worse, you get spooked by a minor pullback and exit a highly profitable trade weeks before you needed to. Two of the most common culprits behind this confusion are the standard Stochastic Oscillator and the Stochastic RSI. Because they share a name, traders frequently assume they do the exact same job. This split-screen chart illustrates the paradox perfectly. Both operate on a 0 to 100 scale, analyzing the same underlying price action. But while the top panel generates a smooth curve with 2 clear signals, the bottom panel triggers 8 frantic reversals over the same time frame. Treating these tools as interchangeable guarantees you misread the actual buying and selling pressure. If you want consistent results, you have to look under the hood. You need to know the specific mechanics driving each line, so you can accurately tell when a trend is completely exhausted and when a fresh breakout is just getting started. The baseline tool is the traditional stochastic oscillator. George Lane developed this formula back in the late 1950s, long before algorithmic trading existed. Lane's logic relies on a very simple observation about market physics. Momentum shifts before price does. By calculating the speed of current transactions, traders can spot early shifts in sentiment before the actual dollar value catches up. Decades later, in 1994, Tushar Chande and Stanley Kroll published a highly modified variation. They called it the Stochastic RSI. At its core, this newer model is an indicator of an indicator. They designed it specifically to locate extreme overbought or oversold conditions that Lane's original, slower formula simply ignored. The difference in their design dictates their pacing. The classic stochastic is built to be a steady marathon runner, pacing itself over long distances. The Stochastic RSI is a twitchy, highly reactive sprinter. Your first job as a trader is resolving that dilemma. You have to decide whether your specific daily routine requires long-term stability or raw, immediate speed. Let's break down the marathon runner first. The traditional stochastic oscillator is deliberate, and it rarely panics during a trading session. Looking at this comparison table, we can see why. Its mechanical input is tied to the raw closing price. It measures exactly where today's close sits relative to the asset's high-low range over a set period, usually 14 days. Because it calculates directly from price action, the resulting signal is heavily smoothed out. It naturally absorbs and ignores the erratic volatility of a Tuesday morning news cycle. The trade-off here is obvious. By filtering out the noise, you inherently introduce a slight delay. You will likely miss the absolute earliest moments of a sudden breakout. This makes it an ideal fit for swing traders. If you operate on daily or weekly charts and prioritize capturing high-probability macro trends, this tool matches your pacing perfectly. Ultimately, the standard stochastic is a defensive instrument. It prioritizes capital protection over trying to squeeze profit out of every single market ripple. If you need faster reaction times, you have to look at the sprinter. Returning to our table, the Stochastic RSI drops raw price entirely. Instead, it applies the stochastic formula to the numerical values of another indicator, the relative strength index. This double-layered math creates extreme sensitivity. The indicator slams into the 0 and 100 extreme boundaries incredibly fast, and it does so frequently throughout a simple session. The advantage to this speed is precision. You can isolate highly lucrative, minute-by-minute micro-movements that a slower indicator would never register.
But that sensitivity introduces a severe structural weakness. You drastically increase your vulnerability to whipsawing. A whipsaw occurs when an indicator gives a false positive. It screams that the asset is oversold and ready to bounce, tricking you into a buy order just moments before the floor falls out and the price continues to crash. Because of this risk, the Stochastic RSI belongs in the hands of day traders and scalpers. These are traders operating inside intraday sands, where a 5-second delay dictates whether a trade is green or red. It is an offensive strategy. You trade certainty for speed, and surviving that environment requires strict stop losses and a very high risk tolerance. Matching the indicator to your personal style is only half the battle. If you deploy the right tool in the wrong market environment, you will still lose capital. Markets typically exist in two states. The first is a ranging market, where the price is trapped, bouncing sideways between predictable support lines at the bottom and resistance lines at the top. The hypersensitive stochastic RSI is an absolute goldmine here. It rapidly tags the top and bottom of that channel, giving you clear entry and exit points for those tight sideways bounces. This chart shows the primary danger zone, a strong, sustained trending market. Look at what happens to the indicator while the price experiences a massive, uninterrupted climb. The stochastic RSI shoots up to the 100 mark immediately, and then it gets pinned. It stays entirely flat against the ceiling, paralyzed by the sheer strength of the upward momentum. This pinning effect creates a highly misleading picture. Every time you look at the chart, the math is screaming that the asset is severely overbought and a crash is imminent. If you trust that signal blindly, you get spooked. You sell your position, lock in a tiny profit, and then sit on the sidelines while the macro trend climbs another 20% over the next month. Applying a micro tool to a macro trend guarantees failure. The external context of the market will always dictate how you read the math. No line drawn on a screen is a magic crystal ball. Whether you choose the marathon runner or sprinter, you cannot rely on them in a vacuum. This dashboard illustrates the strategy of required confirmations. Traders filter out false positives by demanding that momentum tools align with at least one other metric, like volume analysis, structural support and resistance, or moving averages. For example, instead of immediately buying every time the stochastic RSI says the market is oversold, you wait. You only execute the trade if that oversold signal triggers at the exact moment the price physically touches a major historical support level. Layering your confirmations means you will take far fewer trades each week, but the trades you do take carry a significantly higher probability of turning a profit. We map these decisions on a quadrant chart, time frame versus market state. The standard stochastic belongs in the top left quadrant for swing traders on daily charts riding macro trends. The stochastic RSI drops into the bottom right, reserved for day traders hunting fast micro movements in ranging markets. If you are riding a heavy, established macro trend, keep the twitchy tools off your screen entirely. The best way to internalize these mechanics is to observe them in real time. Open your charting platform today and apply both indicators to a single asset. Take 10 minutes to scroll back through the previous month's price action. Trace the peaks and valleys to experience the raw difference in signal speed for yourself without risking a dime of actual capital. Mastering momentum is an ongoing process of aligning your risk management with reality. Choose the pacing that fits your actual schedule, confirm the signals with hard evidence, and let the math work for you.